Yeah, this is a hot number. It gives the Fed permission to keep increasing interest rates.
As much as FTX weighed on crypto prices last month, this week the spotlight was on macroeconomic factors. The latest jobs report was released, and the U.S. economy added more jobs than Wall Street expected. Wages continue to rise as well, and this rapid economic growth is likely to drive more rate hikes from the Fed. That is bad news for risk assets like crypto.
Is the November jobs report a blowout or a disappointment? Are we in recession? The headline number of 263,000 additional non-farm payrolls sounds like robust growth, but is that what most Americans are feeling right now? You see, Bitcoin slipped below $17,000 after the latest jobs report. The addition of 263,000 jobs last month topped forecasts for 200,000, suggesting the central bank faces a longer battle against inflation. Does that mean 75 basis points back? And how is this going to affect the crypto and overall market? To answer all your questions, Cathie Wood has deeply explained the November job report and what effect it will have on Fed's decision and the market. So let's get into the video. But before jumping ahead, don't forget to subscribe to the channel for more videos just like this one.
Well, the unemployment rate stayed at a low at 3.7%, only 0.2 off its low from July and September. Non-farm payrolls were higher. The increase was higher than expected, 263,000 versus the 200,000 expected. But on the other hand, this is a typical economist way of looking at the world. If you look at household employment, that was very disappointing. It declined 138,000. And the divergence between non-farm payroll and household employment is stark. Since March, non-farm payroll jobs created have been 2.7 million. Household jobs created, practically zero, roughly 12,000. So that's since March. And think about that. That is when money growth started declining on a sequential basis. I don't think that's any coincidence. So the other indicators of employment that are pointing down include the Challenger layoff survey. It spiked by more than 400% in the month of November. Now, typically, we don't see that except when we're in a recession, that kind of spike.
Cathie Wood believes recession is no longer a far-sighted thing, but is already happening. Talking about markets and interest rates, the Fed sees the job market is vital in the fight against inflation and wants to see the labour market come into better balance to cool inflation. But with a stronger or hotter than expected jobs report of roughly 263,000 on the top line, it's hard to say things are working for the Fed. So if we look at those numbers, kind of taking a deeper dive, 263,000 on the top number versus 200,000 expected, that's in line with the average growth over the past 3 months of 282,000. So we're not really seeing any cooling here. The unemployment rate remains unchanged at 3.7%. Wage growth is very hot at 5.1% versus 4.6% expected. And remember last Wednesday, Powell said, to be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So he really wants to see wage growth of around 3%. So all of these measures indicate across the board that the job market's still out of balance for the Fed. Let's hear more from Cathie Wood. But before going ahead, don't forget to give a big thumbs up to this video.
And the last one in the employment report itself was the average work week went down 0.1 of a point. Now, this is a pretty stable number. So when it declines, I take note. And it's basically businesses saying, okay, it was so hard to find this employment. I mean, these employees, that I'm not going to lay anyone off right now, but my business is down, so I'll maybe cut the work week and cut overtime. So that's also interesting. And the more this divergence between non-farm payroll and household extends, the more I think the economic indicators are going to start becoming quite weak. I think household always catches the turn in a cycle. And as you know, we think the cycle did turn as household employment was turning in March, and that we fell into a recession then. And probably revisions will cement the case for that. But right now, GDP for the third quarter did come out up. Now, a big part of the reason was imports collapsing as companies tried to clear their shelves of inventory. So that's not exactly a ringing endorsement of how strong the U.S. economy is. Average hourly earnings did increase 0.6%. The expectation was 0.3%. That took the year-over-year wage inflation rate up from 4.9% to 5.1%. And the Fed's definitely watching this. Now, a counter to that is this workweek decline means that total income, so average hourly earnings is just an average, but total income, when you measure all the hours, is not as strong as that wage growth would suggest.
The seemingly robust headline number of 263,000 jobs comes from the Establishment Survey of Businesses, while the unemployment rate comes from the Household Survey. But the Household Survey also has a measure of employment, and that fell by 138,000. In fact, the Household Survey has been flat since March of this year, with essentially no jobs added over that time. Cathie Wood has also mentioned, in the last 8 months, there's been an unprecedentedly large divergence between the two surveys of 2.7 million jobs. One reason for this is that, over the last year, approximately 1/5 of the additional non-farm payrolls have been double counted, not additional people employed. So, what does that imply for the US economy in recession? How much will the Fed raise interest rates this month? Let me know your thoughts in the comment section below. For more videos on the market and the US economy, be sure to subscribe, like, and share the video. Thanks for watching, and we'll see you in the next one.